Welcome back to Investing Talk Podcast.
Today we're looking at energy fuels.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis.
Okay.
When we look at this company, the core thesis is really all about transformation.
Right.
We're watching them shift almost in real time from being, a uranium developer.
Just a company getting assets ready.
Exactly. Into a legitimate multi-commodity producer. So uranium, rare earth elements, heavy mineral sands. It completely changes the long-term story.
And that transition, it's really built on them just executing. You really can't argue with the 2025 results.
No, not at all.
They didn't just meet their guidance. They blew past it. Over 1 million pounds of finished uranium for the year.
That's huge. And for a company in a ramp-up phase, that kind of success is proof management can deliver.
Yep.
And it's the speed of that ramp-up, the accelerating sales, that's so impressive to me.
Right. If you look at the fourth quarter of 2025.
Sales were projected at, 360,000 pounds? That's a 50% sequential jump from Q3.
So they're proving the engine works. They're actually monetizing this production now.
They are. And they're locking in that revenue visibility, too, which is so important.
That's what I love to see. They're not just chasing the volatile spot market. They've secured new long-term contracts with U.S. utilities.
And those deliveries go out as far as 2032.
So you can actually model future cash flow based on that.
Yeah.
For 2026 alone, they have a solid floor of, 780,000 to 880,000 pounds locked in.
That's right. Now let's talk about the Q3 2025 financials because they were a little noisy.
Okay.
Revenue was up a massive 338% year over year, which is fantastic.
But there's a but.
There is. Their cost of sales also jumped dramatically. Nearly 600%.
Oh, so wait, unpack that for us. How can revenue skyrocket, but margins get crushed like that?
It's a classic resource sector decision. It was deliberate.
Okay.
To hit that huge 1 million pound target, to prove to the market and their customers they could deliver, they had to process some of their older, higher cost ore inventory.
So they sacrifice short-term margin.
For those lucrative long-term contracts,
Exactly.
gross margin dropped from 54% all the way down to 28%.
Temporarily, though.
Temporarily. And we will circle back to exactly how they plan to fix that because they do have a clear plan.
Okay, let's definitely earmark that because the real reason the market isn't freaking out about that margin dip is tied to their strategic assets.
It all comes down to one thing.
White Mesa Mill in Utah.
That's the one. It is the absolute fulcrum of this entire investment case.
Because it's the only one. Right?
Yep.
The only conventional uranium mill operating in the entire United States.
The only one. Just think about what that means. The regulatory hurdles, the capital, the local opposition to build a new one. It's practically impossible.
So it's basically an irreplaceable piece of national infrastructure.
It gives them a near monopoly on domestic processing. And that's before we even get to the really exciting part.
The rare earths.
The rare earths. They're leveraging this mill for something completely different.
So how far along are they with that? Is it just an idea on a whiteboard?
Oh, no, they're well past the idea stage. They're already successfully separating REEs there.
Okay.
Their heavy rare earth pilot program was a huge technical success. They recently produced and qualified high-purity dysprosium oxide.
And purity is key here.
Purity is everything. We're talking 99.9% pure.
Wow.
Which means it's good enough for the permanent magnets used in EVs, wind turbines, defense techs. It lets them plug directly into the Western supply chain, moving away from Asian dominance.
So White Mesa is the domestic linchpin, but you can't be a global player without the resources to feed it.
And that's where their international portfolio comes in. You have the Varamata project in Madagascar and the Bahia project in Brazil.
And these aren't just, speculative exploration plays.
No, not at all. These are confirmed world-class assets. Feasibility studies show they have the potential to be low-cost, large-scale sources for REEs and mineral sands.
Let's talk about the scale of that. I saw the numbers from the Varamata study, and they were just staggering. The net present value was confirmed at, $1.8 billion?
It was. And for anyone listening, NPV is basically the estimated value of all the project's future cash flows, what it's expected to earn over its lifetime, all discounted back to today's dollars.
So it puts a real sort of de-risked financial floor under the valuation of that one asset alone.
Precisely. And the study also projected annual EBITDA of over $500 million once it's fully ramped up. That's the blue sky potential the market is trying to price in right now.
And this is all happening with huge policy tailwinds, right? The U.S. government is pouring money into energy and supply chain independence.
Absolutely. The Department of Energy has that $2.7 billion investment fund. I mean, this company is perfectly positioned.
A strategic domestic supplier.
It's not just a commercial story anymore. It's a geopolitical one. And what's really refreshing is that they're funding this ambitious growth without a mountain of debt.
Yeah, the balance sheet is remarkably clean.
No meaningful long-term debt, and they've got about $94 million in cash on hand, plus inventory. That gives them crucial stability and flexibility.
So they can afford to just be aggressive with growth.
And that's the strategy. They're reinvesting everything back into the business, accelerating White Mesa, developing mines, rather than focusing on dividends or buybacks right now.
Okay, so let's finally circle back to that margin fix. You said they have a plan.
They do. And the key is a mine called Pinyon Plain.
Right.
Starting in late 2025 and moving into 2026, they'll begin feeding low-cost, high-grade ore from Pinyon Plain directly into the mill.
And that lower cost ore should bring the overall margins way back up.
That's the lever. This is how you get operational leverage. It's expected to significantly boost margins in 2026 and finally turn all that volume into real profit.
So the market obviously sees this whole story. How is the stock itself behaving?
Technically, it's a leader. It's been running hot.
We saw that with the, 15% jump in the first trading session of 2026 alone?
Exactly. It's trading well above its key long-term moving averages, which confirms a really strong uptrend. And it has a high beta, sitting around 1.85.
Meaning it tends to move more than the overall market.
Right. It gets amplified upside in a risk-on environment like the one we're in for critical minerals.
So sentiment is overwhelmingly bullish. But we do have to talk about the counter-signal here.
The selling.
Yeah, we've seen some institutional profit-taking. One major fund cut its stake by over a third. And there's been some insider selling, too.
Right, about $6.9 million over the last 3 months. And you absolutely have to look at that.
You do.
But you have to put it in context. The stock was up about 184% year-to-date in 2025.
So it's likely just smart diversification, not a lack of conviction from management.
That's how it's being read. It's profit-taking after a parabolic run. Now, the real risk here, the elephant in the room.
It's valuation.
It's the valuation. The stock is trading at a forward price-to-sales multiple hovering around 40.5 times.
When the rest of the industry is closer to 4x.
Exactly. So what that tells you is that the market has already priced in an enormous amount of future growth and success.
Mostly from the rare earth side of the business.
Primarily. It implies the market expects 5x, maybe even 10x revenue growth over the next 3 to 4 years to justify that multiple.
And if there are any delays, any slips in project timelines,
the stock is incredibly vulnerable to a sharp correction. That's the bear case, plain and simple.
So, looking ahead, what are the immediate catalysts we need to watch over the next quarter to see if they can start growing into this valuation?
Well, the most immediate focus will be the next earnings report, which is anticipated in late February.
And what are we looking for in that report specifically?
We need concrete evidence that the margin fix is working. We'll be laser-focused on the precise cost per pound achieved from that Pinyon Plain ore.
And revenue from the RAEs.
Yes. We need to see confirmation of initial rare earth revenue, even if it's small, just to prove that commercialization is truly underway.
And on the project side?
We need updates on the commercial scale shift at White Mesa and critically detailed timelines and financing plans for those massive Varamata and Bahia projects.
Right. That $1.8 billion NPV means nothing if they can't build it.
Absolutely. This is a multi-year hold, not a quarterly trade.
So to summarize the investment pitch here, this company really combines the leading domestic uranium platform
anchored by that irreplaceable White Mesa mill
with this massive, de-risked, world-class rare earth optionality. They're uniquely positioned as a strategic domestic supplier in a critical commodities supercycle.
And here's the final provocative thought I'd leave you with. Given the scale of their global rare earth projects and U.S. government's push for domestic supply security, think about how much strategic value that goes far beyond traditional price-to-earnings metrics is truly locked up in a single piece of infrastructure like the White Mesa mill. That is what the market is trying to price today.
If you want to stay on top of the critical shifts happening in the market, be sure to subscribe to the podcast.